Money was supposed to be solid, a promise stamped in metal, a number typed on a screen. Different ages, same magic trick. When the empire needs more, the money changes. They called it debasement in Rome and quantitative easing today. Different tools, same incentive, stretch scarce resources with elastic money. One clips coins, the other fattens balance sheets. Either way, power buys time, and you pay in prices you don't recognize yet. Rome didn't wake up one morning and decide to break the money. It drifted there, one crisis at a time. War first, then welfare, then walls. And every obligation found the same answer: alter the money before you alter the promises. The denarius began as a statement: silver you could trust. Then came the quiet edicts: less silver, more base metal, the same proud face on the coin. Prices adjusted in a way citizens didn't immediately blame on policy. Merchants blamed greedy bakers, soldiers blamed short waits, senators blamed foreigners. The mint? It kept humming. The mechanism was simple: keep the face value, reduce the intrinsic value, pocket the difference to pay the bills. A fiscal lever disguised as a monetary routine. Rome learned a rhythm. The army returns, payrolls swell, the mint stretches. The people adapt. Contracts get shorter, prices creep, barter rises at the edges, and trust becomes regional instead of imperial. When trust shrinks, money multiplies, because everyone wants more of what they trust less. You can clip a coin only once. You can clip trust for decades. When prices misbehaved, the empire didn't apologize. It legislated. Price edicts, penalties, moral speeches about fairness. But price controls are confession letters. When you're managing symptoms, you've already lost the cause. Officials insisted the money was fine. The bakery said otherwise. So did the tax collector, who now wanted your payment in a specific coin, at a specific purity, on a specific day. The state tolerates inflation until it owes you. Then it rediscovers the importance of sound money. Legions, suppliers, insiders. The first receivers enjoy yesterday's prices with today's money. Everyone else inherits the adjustment. Pattern: create claims, soften the money, blame the market. Quantitative easing, QE, arrived with a promise: liquidity, not debasement. We're swapping assets, not spraying cash. Technically true, operationally explosive. Here's the choreography in plain English. The central bank buys government and mortgage bonds from the street. It pays with newly created bank reserves, money that lives inside the financial system first. Bonds leave the market, yields fall, prices in other assets rise to make room. The wealth effect is supposed to trickle outward, gently. Notice the rhyme with Rome: first receivers again: dealers, asset holders, institutions. They see the new money earliest, in asset prices, not bread prices. Later, households meet it in rents, tuition, healthcare, and the price of the house they now have to chase. Counterpoint for fairness: QE isn't a coin clip, it's a collateral shuffle. But the outcome that matters for you isn't the plumbing, it's the incentives. When deficits need funding at low rates and balance sheets promise calm, money becomes the shock absorber again. This time is different, and also not differences that matter. Roman debasement cut metal content. QE expands reserves and supports government borrowing without touching the currency's unit directly. Rome paid soldiers with coins. Today's states pay promises with bonds, then refinance them into reserves. Convertibility is gone. Your dollar floats in faith and policy. Similarities that matter more. The bill is political. The tool is monetary. The first receivers benefit. The late receivers adjust. Trust migrates from currency to assets to hard goods to networks whenever people feel the game has new rules. Translation: Rome's price edicts are our forward guidance. Their coin clipping is our balance sheet expansion married to fiscal deficits. Their temporary measures met every new emergency. So do ours. The three lenses: how debasement broadcasts in the real world. Lens A: asset prices first. When the monetary backstop grows, discount rates fall. Lower discount rates pull tomorrow's value into today's prices. You notice it in housing, equities, collectibles. Bread lags. Bid-ask spreads tighten where the policy hose points and widen where it doesn't. Lens B: sectors with guaranteed buyers. Rome had legions. We have entitlement schedules, defense procurement, and regulated utilities. Anywhere a buyer is price insensitive, price discovers policy before it discovers value. Lens C, time horizons, shrink, shorter contracts, more subscription models. Not because people love subscriptions, but because issuers love indexed adjustable cash flows when the unit of account is flexible. Emergency measures love the permanent residency. Rome learned this with coin reforms that never quite reformed enough. We learned it when every crisis justified a bigger central bank footprint, from lender of last resort to market maker of first resort. Each time, the rationale is humane: prevent collapse, buy time, smooth employment. Each time, the effect is cumulative. Private risk migrates into public balance sheets. Volatility migrates into the currency. Hammerline: you can outlaw volatility, but you can't destroy it. You relocate it into the money. People don't study balance sheets. They study prices that make them feel poor or rich. Elastic money changes stories faster than it changes math. Homeowners call rising prices equity gains. Renters call it being priced out. Investors call low yields stimulus. Savers call it punishment. Politicians call it investment in the future. Households call it my grocery bill. Rome blamed middlemen. We blame algorithms. Different nouns, same scapegoat for policy choices we prefer not to see. Popular story, QE is debasement because money printer go brrr. Smarter story, QE by itself is a swap, but paired with chronic deficits and political promises, it becomes monetized optionality, a standing offer to socialize costs and privatize early gains. That's the rhyme with Rome. Debasement wasn't just metallurgy, it was governance. And governance loves a lever that voters can't see until later. Fiscal path. When promises outrun taxes, money policy morphs into funding policy. Term premium. If long bonds won't cooperate, the temptation to massage the term structure rises. Balance sheet language. Words like temporary, transitory, flexible average. Translation: we'll be here as long as needed. Break-evens versus realized inflation. If expectations stay calm while lived prices don't, someone is anchoring the story with credibility rather than cash flows. Velocity and bank credit. Reserves aren't groceries. Watch whether banks are multiplying policy into the real economy. Not a trade, a lens, because the game is incentives, not slogans. What survives when money softens? Rome's citizens learned 3 instincts. Upgrade your claims, from coin to grain, from promises to property. Shorten your promises, month-to-month beats year to year when rules are reviewed. Follow the buyer of last resort. If the state guarantees it, prices get political, then generous. Modern echo: people migrate from cash yield to asset yield. Contracts index themselves, quietly. Communities rebuild trust outside the unit of account. Brands, skills, networks. None of this is doom. It's adaptation. Your job is to see it early and translate it into choices that fit your life. The Roman timeline in one breath. Strong silver, crisis. Reform, another crisis. Less silver. Price edict, regional money. A new standard with old problems. Empires don't fall because they debase. They debase because they're falling. Then the feedback loop accelerates. Today's one-breath version: soundbite independence. Emergency program, market calm. Bigger promises, another emergency. Larger program, calmer markets. Pricier life, elastic money moves the finish line. Savers discover their enough was miscalculated. Young families learn that home ownership migrated from wage work to asset lottery. Small businesses become reluctant macro tourists because payroll is now a macro bet. This is why monetary debates feel moral. They're really about distribution, when you meet the new money and where it lands first. But wait, what if we're wrong? Intellectually honest check QE also stabilized a system that was genuinely at risk. Without a lender and market maker of last resort, the plumbing could have failed. In that world, your job wouldn't exist to complain about rent. Stability has value, even if the bill shows up later. So the real question isn't QE good or bad. It's, what do we price when stability is bought with tomorrow's money? The fastest way to stretch a promise is to stretch the money that redeems it. We don't clip coins, we clip discount rates. We don't melt silver. We melt risk into the currency. Different century, same incentive. If you understand the incentive, you won't be surprised by the outcome. History isn't a museum. It's a manual. If you want more clear-eyed analysis like this, where the past decrypts the present, subscribe to Master Luxury Finance. Like the video, leave your take in the comments, and share it with someone who still thinks money is just a number on a screen.